Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 9th of March. I'm Daniel Lam, your host for the podcast. Keen listeners to this podcast may remember that towards the end of February, I spoke about how investors have been buying call options on the S&P 500 volatility index, i.e. the VIX index, betting that volatility would be on the rise. Now, dealers, having sold such call options to investors, would need to hedge out their positions by taking the opposite position. Because dealers capture the spread, and they don't put on directional trades. Hence, they would be shorting VIX futures to neutralize their exposure. However, if there were to be a sharp spike in the VIX index, these dealers would need to cover their positions by buying back these shorts, leading to exacerbation of market volatility as the market gets more volatile. The other important technical factor is the rise in popularity of zero-day to expiry, daily and weekly options. Now these have daily notional volume at $1 trillion per day. Essentially, they are options which are out the money and about to expire. But if there were to be a big move in the markets, these options do get in the money, and the sellers would be forced to cover, leading to large directional flows and exacerbating volatility in the markets once again. So similar to the effect we mentioned earlier regarding call options on the VIX index. Well, underlying both of these, we do need a catalyst or a trigger point for the VIX to have the initial spike. And Jay Powell's testimony to the Congress is ratcheting the already increasing expectations of a more hawkish Fed. This could well be the tipping point, especially when the VIX was just coming off its low base at 18%. Now, for the longer term, dynamics in asset allocation may also lead to pressure on equities, resulting in potential rise in longer-term volatility. Pension assets are worth roughly $57 trillion in the 22 largest pension markets. Now, these assets used to be underfunded, with low bond yields to discount future liabilities. However, with the higher yield levels, these assets are now overfunded. Thus, asset allocators would be locking in favorable funding status by selling equities and buying bonds. Now, if this reallocation increases to, say, 3 to 4% of the assets, that would result in $1 trillion of equity selling over a year. This flow is larger than potential combined systematic inflow from low volatility. So, with the potential rise in volatility, we should stay safe, add to high-quality bonds, especially extending average maturities in your bond portfolio. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.